$8 billion was unaccounted for. The amount did not come from a single event. It was not linked to a specific trade or a sudden market shock. It appeared during internal reviews, when withdrawals could no longer be met in full. By that point, the shortfall already existed. No one had addressed it earlier. FTX presented itself as a structured and reliable platform. It offered fast trade execution and high liquidity. The interface resembled professional trading software rather than retail-oriented crypto platforms. For many users, this signaled operational maturity. FTX processed withdrawals consistently. Users were able to access funds without delay. Markets functioned smoothly even during periods of volatility. Reliability became the primary indicator of safety. Few customers asked for detailed disclosures about custody or reserves. The company emphasized compliance and risk management. It hired staff with regulatory and legal backgrounds. It communicated with policymakers and regulators. This reinforced the perception that FTX was distinct from less formal crypto exchanges. The public image of Sam Bankman-Fried supported that perception. He spoke in technical terms. He emphasized probability, risk, and expected value. There was little emphasis on promotion or speculation. This style was interpreted as seriousness. FTX grew rapidly. Retail users were followed by professional traders. Institutional participants began testing the platform. Daily transaction volumes increased significantly. Confidence grew alongside scale. Financial details remained private. However, the absence of withdrawal problems substituted for formal transparency. As long as funds could be accessed, users assumed those funds were held securely. This assumption went largely unexamined. Operating alongside FTX was Alameda Research. Alameda was a proprietary trading firm. FTX was an exchange. The two entities were described as separate. In practice, their operations overlapped. Alameda had been founded earlier and shared close leadership ties with FTX. It was one of the largest trading firms active on the exchange. It acted as a significant market maker. This role involved privileged access to liquidity. Internal systems reportedly allowed Alameda higher leverage limits and different liquidation rules. These arrangements were not disclosed publicly. From the perspective of customers, trading activity appeared normal. Customer deposits on FTX were intended to remain segregated. They were meant to be held for withdrawal on demand. Internally, however, funds were transferred. Money moved from FTX-controlled accounts to Alameda. Transfers occurred for several reasons. Some were framed as loans. Others were margin support for trading positions. Documentation was inconsistent. Transfers were described as temporary. Many were not reversed. As a result, FTX became dependent on Alameda's financial health. Alameda relied on continued access to funds. The balance sheets of both entities became linked. Risk that should have remained separate became shared. Alameda engaged in leveraged trading strategies. It held positions in assets with limited liquidity. Some assets were closely associated with FTX. Their market value depended on confidence and trading volume. When prices were stable, losses were not immediately realized. Accounting values remained positive. The system continued operating. There was no immediate pressure to unwind positions. Over time, losses accumulated. To maintain positions, Alameda required additional funding. That funding came from customer deposits. The shortfall increased gradually. There was no single point at which the problem became unavoidable. Controls that might have limited transfers were not in place. Oversight relied on informal decision-making. The gap between liabilities and assets expanded quietly. The collapse began with increased scrutiny. Public reporting raised questions about Alameda's balance sheet. Observers noted its reliance on illiquid assets. This introduced concerns about FTX's exposure. Withdrawal activity increased. Initially, FTX processed requests as usual. Liquidity was sufficient in the short term. However, withdrawals continued at a higher rate. The exchange required liquid funds to meet demand. Many assets were not readily convertible to cash. Funds previously transferred to Alameda were unavailable. To meet withdrawals, assets had to be sold. Sales reduced market prices. Lower prices increased losses on existing positions. This created further funding needs. The interaction formed a reinforcing cycle. Withdrawals reduced liquidity. Reduced liquidity increased losses. Losses increased funding requirements. Each step made the next more difficult. Internal teams attempted to reconcile balances. At this stage, the size of the shortfall became clear. Estimates varied but converged on approximately $8 billion. This represented the difference between customer obligations and accessible assets. The amount was not tied to a specific transaction. It reflected cumulative transfers over time. Temporary measures had become permanent. Liabilities exceeded available funds. FTX suspended withdrawals. Public communication acknowledged liquidity constraints. Potential acquisition discussions began. External parties reviewed internal records. They found incomplete documentation and unclear asset segregation. There was no straightforward accounting of customer funds. The proposed transactions did not proceed. FTX entered bankruptcy. The $8 billion shortfall became part of public filings. What had been concealed by normal operations was revealed under stress. The collapse highlighted deficiencies in internal controls. Customer funds were not fully segregated. Risk limits were inconsistently applied. Oversight was informal. The organization scaled rapidly without corresponding governance systems. Processes suitable for a small operation were used at large scale. Record-keeping was incomplete. Authorization procedures were unclear. Customers lacked visibility into reserves. They could not observe internal transfers. They relied on withdrawal functionality as evidence of solvency. When withdrawals stopped, that assumption failed. The shortfall had existed before public awareness. Operational continuity delayed scrutiny. The broader industry responded. Some exchanges began publishing reserve attestations. Users requested greater transparency. Regulatory attention increased. These changes did not affect the missing funds. The $8 billion gap remained unresolved. Recovery efforts focused on asset liquidation and legal proceedings. The failure was not caused by a single market event. It resulted from prolonged interdependence between entities. Boundaries between exchange operations and trading activity were unclear. As long as conditions were favorable, the structure held. When conditions changed, underlying weaknesses surfaced. The exchange continued functioning until withdrawals increased beyond capacity. At that point, existing imbalances became visible. $8 billion accumulated through repeated decisions. Each transfer was manageable in isolation. Together, they produced a deficit that could not be covered. When withdrawals required full reconciliation, the ledger could not be balanced.